My name is Daniel Fowler, and I'll be talking a little bit about the competitor and financial analysis that we've performed, as well as the key problem and the recommendations that we have to go along with that. Each of these organizations are tailored for R&D, manufacturing, and marketing within the area of medical devices. And these are the three primary competitors that we chose to do analysis on. You can see Abbott there. They are primarily a pharmaceutical company, but they also have vascular and diagnostic products as part of their offering. Recently, they have a partnership with Bigfoot Biomedical, and that was in response to the merger of Medtronic and Covington, and additionally, Abbott has acquired St. Jude Medical, which happened recently with a $25 billion cash and stock deal. Again, those are the two biggest companies kind of fighting it out right now. Boston Scientific, they have a product offering in cardiology, endoscopy, urology, and other areas of equipment and operating rhythm management. They recently purchased Symetis. Again, in the medical device market space, you see a lot of consolidation. That's how a lot of these groups get new tech, get new IP, and get new market space. Stryker, again, they are focused on orthopedic and other neurotechnology, spinal products and that sort of thing. They recently acquired Novadac, or excuse me, they're working to acquire Novadac right now. Again, same kind of thing. They are looking for the operating synergies that they can gain by acquiring different groups and the IP and that sort of thing. Again, it's a whole industry wide push right now. Next, we have a little bit of information about the industry itself. You can see the segmentation here of the different types of products. The vast majority are in cardiovascular and irradiation devices. That's a space that these four companies play in quite a bit. The information that we worked with was based on the North American Industry Classification System, and we looked at the industry that's coded 334,510, which is electromedical apparatus manufacturing. This U.S. industry comprises establishments that are primarily engaged in manufacturing electromedical and electrotherapeutic apparatus such as MRI equipment, ultrasound equipment, pacemakers, and that sort of thing. Factors that impacted the medical device manufacturing industry over the past 5 years are healthcare reform, technological advancements, outsourcing, governmental regulation, and an increasing aging population. And this will continue to drive the industry development over the next 5 years. The combined effects of these different factors is a revenue growth that's an annualized rate of 2.9%. And you can see here that from 2018, it looks like we're going to go from about $43.5 billion up to over $50 billion in 2023. So lots of growth in this industry. And a lot of the growth is based on the changing demographics of the United States. And then although the majority of baby boomers are still under the age of 65, a significant portion of this group will cross that age threshold in the next 5 years. And so that's going to result in an annualized growth of 3.3% of the 65 and over demographic. That, along with the medical innovations that continue to expand the average lifespan, such as biotechnology and 3D printing, are likely to enable the development of additional therapeutic and diagnostic product lines, which will benefit all four companies. So very good outlook for these groups. On the financial analysis, what we chose was to look at the return on investment, the times interest earned, and the inventory to net working capital. We thought that those three ratios really represented the trends that the company showed and gave some good insight into what was going on. For the return on investment, note that Boston Scientific really struggled in 2014 and 15, but they were able to catch up to Medtronic and Abbott in 2016. Also note that Stryker is well above the competition. They're ranked number 9 in the medical equipment supplies industry, but a lot of what their strength is attributed to is the diversification revenue model that they've got in place, and really trying to look at the medical market as a whole and not getting pigeonholed into one little niche market. For the key leverage ratio, we looked at times interest earned, also known as the interest coverage ratio. And the interesting thing about this is that Boston Scientific was negative and would additionally very low, far below the other companies. So if you continue to watch this trend, which, if you're investing in this area, you'd want to, it would mean that they're going to have to dip into their cash, or they're going to have to endure additional debt to continue to make their payments on other things. So again, Stryker is leading the pack with a really strong cash strategy and use of debt in moderation. And then lastly, the liquidity ratio that we chose is inventory to net working capital. And this really is an indication of how much inventory is financed with the available cash. Boston Scientific has a significantly large negative ratio, and this is due to a significant increase in current liabilities. They have a debt obligation of around $62 million and a significant accounts payable of $238 million and accrued expenses of $342 million and other liabilities of $561 million. And according to a news release from Boston Scientific in February of this year, they said these results include intangible asset impairment charges, acquisition, litigation, restructuring, and restructuring related charges of $1.2 billion after tax, which came out to 86 cents per share. So Boston Scientific, even though they're one of the larger competitors in this space, is really hurting at this point. So that gets to our key problem and recommendations. The key problem that we came up with was that Medtronic really needs to be able to leverage the coveted acquisition to deliver significant growth. And in order to do that, there were three areas that they could focus on. One was the emerging markets, look at global markets, what they could do there. The second one was leveraging the acquisition to increase the breadth and depth of the product lines that they offer. And then third, they could focus on the back office and supply chain and try to work the synergies that are there between the two companies. What we suggested was the primary recommendation was to really focus on the emerging markets. We thought this was really where the growth would be. The emerging market sales currently are estimated to be $4 billion and continuing to grow at a mid-teens percentage rate, so significant growth in there. That does not include the Chinese market. The Chinese market is really poised to grow quite a bit. The Chinese government has really eased regulations there, and this is really trying to get more healthcare universally across the country. In 2003, about 30% of the folks had public health insurance, and that's up to 90% today. So a really big growth market there. And then there'd also be emerging market profitability as they go forward by removing manufacturing overlap in those different markets as well. So thank you for your time today. We appreciate you listening in on our presentation, and we welcome any questions or comments that you might have. Thank you.